Thank you very much again, Joseph, for
Thank you, Charlie.
for the interview. We're very glad to have you. Uh, Tell us about your background, where you grew up, and how did you come up. So, what did you do before you started the business?
Yeah. So I'm born and raised in Los Angeles, and my family's. I guess I'll lead into our process. I could give you a little, genesis for how our process started, how I became interested in the business. But my great grandfather immigrated to the United States from Croatia in the early 1900s and started farming on an acre of land in North Hollywood. And and so it's a family business. My family's been farming in Southern California for several generations. And my dad, who I work with, that was his first career in that business. And when he was in his late 20s, early 30s, he was asked to serve on the board of a small regional bank called Santa Clarita National Bank. And at the time, my family's business was that bank's largest client, so it made sense to the bank to have board representation. And so it was a unique experience for my dad at a young age. And my dad, he had a natural interest in investing and kind of got sidetracked in this family business, as I said, as part of his first career. And he joined the bank, and the first couple of board meetings, he noticed that it was a public traded bank, but it was small and illiquid, so there wasn't a lot of float. And this is, in the days before computers, so there was a board book every board meeting, and there was always a page of the board book dedicated to stock transactions. And he always noticed how every board meeting, every stock transaction that had happened the prior quarter, it was always the chairman of the bank buying stock from whoever was selling. And he noticed this, quarter after quarter after quarter, and finally he sat there, and I think if you use common sense, he said, well, that's interesting. The chairman of the bank is buying stock ferociously any opportunity he has. Maybe I should try to buy stock alongside of him. So, he asked the chairman of the bank. The chairman of the bank allowed him to buy stock alongside of him, and my dad put basically his life savings into that stock in his early 20s, and fast forward several quarters. And Santa Clarita National Bank ended up selling to First Pacific Bank, which was then bought by Bank of America. And in his mid-30s, my dad made quite a bit of money. But I think the lesson learned for him at that point was no matter how well you think you know a company, no matter how sound your analysis is, you probably don't know as much as the people running that company. So, as a first principle, in our process, we monitor every stock transaction by insiders. We study the proxy as kind of a first document we look at. But, that lesson's really kind of ingrained in the DNA of this company. And it's, watch what management does. And maybe that's the most intelligent, screening mechanism. So I kind of jumped ahead a little bit, but to answer your question, so at the time, my dad, he's still in the family business, but loves investing and has always invested in his own money. And I went to the University of Southern California. I studied business and finance at USC, and I also played on the football team for the Trojans. And I was working out in the weight room one day, and our director of football operations walked up to me and said, "Hey, Joe, would you have any interest in interning at Bear Stearns and Company?" And USC has a great alumni network, and we also have a very proud football tradition. So I was kind of afforded that opportunity early on, and this was during my sophomore year in college. But I interned at Bear Stearns. I had two great mentors at Bear, one of which I'm still pretty close with today. But like I said, they were great mentors. They both taught me a lot about the business. And I would say that was really what, my first interest. That's kind of what sparked the interest in me as it relates to the investment management business. And, so dug in a little bit more, read a couple of books. It just so happened at that time, my dad, who was in the family business, had always kind of been chomping at the bit to be in the investment business. But when you're in your mid 40s, what do? You go be a junior stockbroker at Merrill Lynch in your mid 40s. You can't do that. But the individual that he had always worked with his entire life, and he was a broker at that time at Bear Stearns, and he approached my dad and said, "I'm leaving Bear Stearns and I'm starting my own money management business. We've generated a lot of ideas together. I have great respect for your reputation and the people that you know, and your family's been in LA since for 100 years. Would you ever leave the family business and join me as my partner?" And my dad did. He did that midlife career change, and so after that experience at Bear Stearns for a couple of years, kind of on and off, I worked at that kind of startup money management firm, and learned a lot from my dad, learned a lot from the other partners at that business, and just kind of got further entrenched in investing. And it was different than Bear Stearns in that this was more dedicated to actual stock picking and value investing, and that's the field that I am in today. And then from there you just read. The one thing about the investment management business, and you guys know this, but it's almost like it's like a fountain of knowledge. And if you are interested in it, and if you are passionate about it, there are so many great people that have come before us and already done this and put their thoughts and the lessons learned in books and on paper and on interviews. So Warren Buffett, Charlie Munger, Bruce Greenwald, Joel Greenblatt, Seth Klarman, the list goes on and on and on. And then studying business leaders that have run businesses, from a John Malone to a Bill Sturz, any of those guys profiled in The Outsiders. And there's just so much information out there. And if you really entrench yourself in all of that information, it's addictive. And so I really enjoy it. And like I said, I've had some great mentors, and that's pretty key to kind of getting to it. But that was my introduction into the business, and so then we started this company in 2008, and I'm partners with my dad, and we started it with two other partners, and we built a great team, and it is fun. We love what we do, and hopefully over time our performance shows that we're good at what we do.
So basically, you started with you have four people. Four people started the business, including you and your dad.
Yep.
Okay. How much money you were managing at the beginning? Is it only your money, your own money, or some other people's money also?
Yeah, so we launched with 15 million in assets. It was mainly friends and family. Like I said, my family's been in Los Angeles for 100 years, and my grandfather and both my dad are honorable people and have lived their life the right way and treated people well. So they have great reputations, and like I said, we've been in Los Angeles for 100 years. So he's built up great relationships. So we're lucky that a lot of people trusted us early on, and like I said, we're able to launch with 15 million, and we've grown our business over time with kind of built on those relationships that we've built over a lifetime. But then also we had some great performance the first 5 years, and as you guys know, good numbers will attract assets. So
for the four people you started, are you all full-time or only some of you full-time?
Yeah, no, we're all full-time.
But you didn't take salaries, I assume. Did you take salaries? Did you take...
Very modest salaries, and we were able to launch with some seed capital from friends and family, so that helped a little bit. But it was tough early on, and the original four partners that launched it were not all four still here. Me, my dad, and my partner Chad are still here, and we've had a few people join and leave along the way. And one of the hardest things about any business, and I really didn't know this until we started Old West, but getting the culture right is difficult. and it's taken a while, but here we are 10 years into it, and I believe that today we have a great culture. As I mentioned, 3 of the original partners are here. A couple of years ago, a 4th partner joined us, Brian Lax, and he's been great and really bought into what we do, and it's a big part of our company. So, I feel like we finally have the culture right, and I'm really excited about the next 5 to 10 years. It's funny, early on you have conversations with allocators, and you hear like 10-year track record, 10-year track record, and I never really understood that at first. Like, why do you need a 10-year track record if you like the people in the process? And now that we're 10 years into it, I guess I kind of see why they want a 10-year track record, because it almost takes 10 years to kind of get that culture right and have the dynamics right. So
We are actually very interested in the earlier years because I think that was the most difficult years of any business. The first 5 years, the first.
oh
Yeah. So
well,
tell
yeah.
us more about that part. The first 5 years, how
Well,
hard
so,
working you were, and how hard to get clients that time.
yeah. Well, so know, the first 5 years were definitely difficult and tough. But for us, it was almost like the next 5 years were the hardest, just because of this, the passive, active, and So we started in 2008. So in hindsight, you sit there and you go, well, you've had 10 great years at your back, right? The market's just gone straight up, and to some extent that's right. But if you're an active money manager, it's tough. So I think if you look at our first 5 years in business, Morningstar, Investment Alliance, all the different databases that track performance. I mean, I don't think our performance was top quartile the first 5 years. I think it was like top decile. We were top 2 or 3% in every asset class that we manage. Performance was great. As a result, we did raise assets, and I think we probably got to 220 million through our first 5 years. The last 5 years have been really difficult, though, and it hasn't been kind to active stock pickers. And you guys have seen the data, and I know your listeners have seen the data, but you've had trillions and trillions of dollars flow into passive index funds. And the indexes, they're all cap weighted. They're not equal weighted. So as $100 is invested in the index, it pushes the biggest names up higher. And it's just, I think it's kind of a mania. And you've had a lot of smart people from Jeff Gundlach and Michael Burry. They've, talked about it recently, and we'll see what happens. And, just yesterday, I don't know if you guys read the article. I think it was the front page of the Wall Street Journal, but it was Twilight of the Stock Pickers was the title of the article, and it talks about how for 3 straight years, people have been redeeming funds managed by active managers in favor of passive strategies. And so if you invested $100 in the S&P 500 today, about $20 I think goes into the top 10 names.
All right.
13 cents goes into the bottom 10 names, which is crazy. And I actually remember in one of our investor letters, I think it was our third quarter 2018 investor letter, and we had the market had the horrible fourth quarter, which gave back all the gains, and I think the market finished down maybe 6% last year. But if you guys recall, through the end of the third quarter, the market was up about 10%. And we wrote in our investor letter how the top 10 stocks in the S&P 500, so basically the FANG stocks, right? Facebook, Apple, Amazon, Google, Netflix is a FANG, but it's not a top 10 stock. But if you took those top 10 stocks, over 100% of the year-to-date returns through the third quarter were in those top 10 stocks. So if you stripped out those top 10 stocks and you looked at the S&P 490, the market was negative. And that's kind of been the story to a large extent the last several years. So if you just threw your money in the basket, you've done better. And the funny thing, So what does an active manager do, right? So an active manager, they're digging through the corporate filings, staying up until 2 a.m. reading a 10K, getting to know the management teams. So I think, if you use common sense, and I think, in life in general, right? In 2008, when you had the financial blow up, a lot of things just didn't make sense and people kept on doing them. And so I think in the end, reality has to come back to earth. And I just think there's a lot of things that don't make sense right now. And it doesn't make sense that someone that is diligent in their work is underperforming, just kind of throw the dart at the dartboard. And so, anyways, the whole point of this, what I'm saying is the last 5 years has been tough because if you haven't owned the FANG stocks, which we haven't, you've underperformed. So the first 5 years were tough because we were starting a business, and the second 5 years have been tough because we've been, fighting against this tide of passive managers. And as it seems like there's a new fund that goes out of business every day. But I'm convinced that just like in any downturn, the people that are able to, keep their head down and work hard and do what they're doing, when the tide turns, look at the investment business today. Who are the great investment managers that we all think of as the best? They're all the guys that in 1999 and 2000, when the market blew up, they did great. And I'm not predicting that the market's going to blow up, but I could easily see a scenario where the market just kind of flat for a 10-year period. Well, if you're a manager and you could be 10%, 12%, 15% annualized over that 10-year period, so anyways, I'm excited about our next 10 years, but the first 10 years has been fun. I've enjoyed building this business. I've enjoyed being with my partners. I've enjoyed working with my dad. But it's definitely been challenging. So I'm excited for the future.
The question is, are you losing any clients in the last 5 years due to you underperformed the passive investment? Did you?
Yeah, so we have lost clients, but we've also gained a few clients.
Okay.
If you look at our total assets under management, we haven't lost a lot of assets, and that's really a testament to our clients and the type of people we built our business with. And most of these managers that I talk about that have gone out of business, their business was really built on institutional allocations, right? And a lot of the institutional world, if you underperform for 12 months, you're on the watch list, and if you underperform for 18 months, you're toast. We have a lot of great clients, and they are with us because of our process and the names that we own. And we write quarterly letters, and we try to be very transparent and talk about our names in the letters. So we're blessed with great clients.
Tell us how hard you work.
Well, so it's funny. The one thing about the investment management business, a lot of jobs you go home at the end of the day and you punch a time clock, right? And when you punch out, you're done, and you're on to other things. And this is a business where you really never stop working. You never stop reading. You never stop thinking about your investments. You never stop. It's almost like you're working 24/7, and in the investment management business, it's more of a lifestyle than a business, right? It's you live your work, and it doesn't always make you the most balanced person, but that's why you have to love what you do. If you don't love what you do, this isn't the business for you.
Absolutely. So you did mention that those first 5 years you had some pretty early success. What would you say were some of the things you did right during that time?
Yeah. I think first off, I think when you you start a company. What's your process? What's your investment strategy? And, I think that we have a pretty crystal clear investment strategy. And, it's two-pronged. Well, first off, I would say our process, I just think it makes a lot of common sense. I've heard many people, say, hey, I met with this financial advisor or money manager, and they explained what they do, and they put all these charts up, and I didn't really understand it, but they sounded smart, and I just think that's tough, right? I mean, if you're if you're a momentum investor, or if you're just going to, invest in a basket of stocks, or if you're going to, be a technician, I just think it's all about performance. But when you have, a sound, thoughtful investment process that people can understand, and, and as I said earlier, we as a first principle, we want to only invest in companies where management is aligned with us as investors. So we look for, typically how we would screen for ideas, a name could come into our focus in a number of ways, but every day, and we've been doing this for 20 years, we go, my dad actually does this, and he's been doing this, I think, for 30 years, but, we go through every SEC Form 4 filing from the day before. So if we see a CEO, a director, CFO, someone that's part of management, write a check buying $5 million worth of stock with their own after-tax capital, that doesn't mean we're going to go buy alongside of them. But if that CEO thinks a $5 million investment into his own company, where he, in theory, knows more about that company than anyone else, is a good decision, we're going to dig in. We're going to print out the proxy, and we're going to try to see if we could see what he does. And the same, we closely watch 13D filings. There, are probably 20 or 30 different investors that we have a high regard for, and we respect the work that they do, and we look at their 13F filings on a quarterly basis. And once again, it doesn't mean that they're right, and we're going to go follow them into that investment, but we know how hard they work. We understand their process. We have such a high regard for them that, we're going to spend, at a minimum, a couple of hours trying to dive in and see if we can see what they do. And I think that is probably the most intelligent starting point versus, reading some sell-side research report, or, reading the Wall Street Journal or Barron's on the weekend. Look at what people are doing with their own money. So I would say that's kind of, and then from there, the first document we typically would look at is the proxy statement. And as your listeners know, the proxy statement is going to detail stock ownership, compensation, and I would say, what's important to us is what metrics are compensation tied to. Are they shareholder-friendly metrics? And so that would kind of be prong one of the research process, and prong two would be, at our core, we're value investors, and we don't want to overpay for businesses. And with that said, cheap businesses are cheap usually for a reason, and so we try to identify some hard or soft catalyst that will unlock that value and make the stock appreciate at the end of the day. But anyways, to get back to your question, I think that process it's thoughtful, it's full of common sense, and I think when you express that to your clients, and when you, as I said, anybody that has an interest, they could go to our website and read all of our quarterly letters, and in each quarterly letter, we talk about at least one of our holdings, and at times we discuss that holding in depth. And I think if you go through and read our last couple of years' quarterly letters, I mean, you're basically reading 75% of the fund, and so I think that clarity is appreciated by our clients, and I think separates us. And there's a lot of fund managers out there that do what we do, and you know those guys. So I think people that are in the investment management business can identify those managers, but to the general public, it's a dying breed. No, I mean, no, studying a company and investing in a company where management is making smart capital allocation decisions, and it's like who does that anymore, right? So anyways, it's fun.
Actually, just by the way, you on GuruFocus you can use our insider data to set up alerts. If there's some new CEO buys, big CEO buys, you can get an email alerts for that. You don't have to go
Yeah.
through every one of them yourself.
No, hey, GuruFocus, and actually when Charlie, when you reached out and invited me to speak at the conference this year, I mean, I was very honored because GuruFocus it's a database and a resource, that I've known of and have looked to for, a long time. So having you guys reach out to me was kind of, it was an honor.
Thank you.
Definitely. So obviously, we've talked about a lot of success along the way, a lot of happy moments. Do you feel anywhere along those lines you've made any mistakes that looking in hindsight, you wish you could go back and fix, or things about the business that you wish you could change that you don't like at this point in time?
Oh, I mean, we've made tons of mistakes, right? And I mean, getting back to the allocator saying 10-year track record, it's like I get it, right? Because you make a lot of mistakes in the first 10 years, and like I said, with our culture, I think we probably had hired people at times that we should have never hired, and anyways, we've gotten that right. Our culture is great. You learn a lot of lessons too in invest. One of the great things about the investment management business is it's one of the few businesses where, in theory, you only get better and better. I mean, until you dementia starts hitting it. But yeah, I mean, you could argue that Warren Buffett and Charlie Munger are better today than they've ever been, and here they are in their 90s. So the great investors, I mean, all make mistakes, but it's what do you do with those mistakes, and how do you learn from it? And yeah, I mean, we made plenty of mistakes on the investing side. We kind of got hit in 2014 when the energy price, energy collapse, and whatever oil fell from what was it, like $100 to $30, and we owned a couple of really good companies run by owner managers, but a couple of those companies had too much debt, and like that was a big lesson. I don't think I will ever have any interest in owning a commodity company that has too much leverage. I think you hear a lot of value investors say, I'm not going to own commodities because the price of the commodity is unknowable, and I understand that, but I where I disagree is I think that a lot of money could be made in commodities, but I think the key to invest in commodities is pay close attention to debt, right? Because a good company could come out of a downturn stronger than ever before if debt doesn't sink them before. So we got hurt with a couple of companies there. We've owned a couple of companies that we bought because we felt that they were represented great value, value situations, some of the part analysis. But once again, I think where we've evolved as investors is I don't know that I would ever have any interest again in owning a company that is not at least stable or slightly growing when you look at revenue, because if that business is in decline and it's a sum of the parts story, it doesn't matter how cheap it is because the clock's ticking.
Right.
So if that value doesn't get unlocked, whatever over the next year or 2 years, it's no longer cheap. So I don't know that Yeah, so I think, investing's hard enough. Why own a business that's where there's not where it's not a secular growth story? Why buy a business in decline because it's cheap? Because, like I said, now the clock's ticking, right? So yeah, I mean, you learn a ton of lessons, but it's it's been fun, and thankfully we've made more good decisions than bad decisions, and I look at where we are today, and I just think we're positioned perfectly. Um, we're managing, like I said, around 200 million. Um, I don't know how long this passive mania continues, but it can't continue indefinitely. So I think to be where we are, kind of at the when the passive mania or the market kind of seems frothy, I just think we're in a great spot. So very excited about our future.
You mentioned that you hired someone that you wish you didn't hire. So now, if you hire today, what kind of people will you hire?
Well, so I actually would love to grow our team. I think we need to get a little bigger in terms of assets, but one of the best decisions I think we've made. You talk about making what are good decisions that you've made, but about 5 years ago, we started an intern program, and these weren't interns like me. I interned at Bear Stearns. Well, when I went to go intern at Bear Stearns, I did not know much at all about the investing business. But Bear Stearns was a big company, and they had people dedicated full time to that intern program and setting up lunches and introducing you to business leaders. So that was a great experience for me. Although there are tons of young people that can be enriched with that sort of opportunity, we're a small company. We don't have a whole lot of time to dedicate just to an intern program. So, several years ago, we put this intern posting with a group at USC, the USC Value Investment Group. So what's crazy is these kids are all freshmen and sophomores, but they're remember. The first guy that we had, he came in and interviewed, and I gave him a list of what I thought were some, the five, best investing books for someone young to learn. And I've read all five. He goes, have you read these three? And it's like, I was like, holy cow! Well, no, I haven't read those three. And but this kid had such incredible passion. And anyways, he came in and interned for us. That was his freshman year. Then after that, he went to go work and he worked at Harris Associates in Chicago. Then after that, he went and he interned at Value Act in San Francisco. And now he's working full time at a money management firm. I can't think of it, but a famous one here in Los Angeles. But so it started with him, and there were two other kids, and then those three interns, they they recommended, they basically did the interviewing and picked our interns the following year. But we've year in and year out, we've had this intern program, and it's evolved, and now I think there's 12 or 15 kids that have now interned for us, and passionate about the business, very smart, love value investing. A lot of them have now, have careers in this business. So I think, if we were to build a bigger investment team, I would hire several of those kids. They're kind of, hire right out of that investment team. So look, I think you always need to, be cautious that maybe you're not right. You don't have all the answers. Maybe there's another way or strategy of making money. Clearly there are, because investors have made money a lot of different ways. But one of the great things with bringing these kids in early on is I think there's a few tenets of our philosophy, such as owner managers, only look at companies where management owns a lot of stock. So there's a few principles that we hold near and dear that someone else wouldn't pay a lot of credence to. And I just think that's for us to look at an investment, it needs to meet certain criteria.
Mm-hmm. So, looking at new people, you mentioned you'd love to expand in the future. Are there any future plans for expansion currently in process, or anything you're really excited about moving forward at this point in time?
Yeah, I mean, not really. We have a great team today. We have a 4-person investment team. I think we're perfectly, positioned to manage a lot more than we're currently managing and grow and get a lot bigger than we currently are with the team currently in place. But yeah, I think there's a lot of, great analysts, a lot of great people on the investment side that we would love to talk to. But I think, that's also a function of resources, and I think we would have to, be bigger before we really thought about building out our team.
For sure. And at this point, do you find that there are any, I guess, risk factors or threats that you see in the industry that could affect you guys moving into the future, or are you feeling pretty confident where you're sitting right now?
Yeah, well, I think passive investing, right? Passive investing and algorithms. I think that's clearly a threat to the active management industry, and I think it's a mania. I think it's a bubble. I don't think it could go on for that much longer, but I've been saying that for a while. So, the one thing that I've learned is, so we have the ability to short in our strategies, and thankfully, we've always been net long and haven't had a lot of short exposure, but we've had bigger short exposure than we do today, and we've gotten hurt. We've gotten hurt badly on the short side, and I used to think very bottom up, and I still think bottom up. I think you need to think bottom up, but I didn't really spend any time thinking about top down. And the problem with that is in this environment that we live in. So first of all, we talk about the market, right? The market being high and this index fund mania. Well, I believe the only reason the market's here, the only reason that we have it, it's all central bank debauchery and manipulation. 0% interest rates, $15 trillion worldwide of negative interest rates. So what does that do? That just that pushes money into riskier assets, real estate, stock market, all-time, cap rates are at all-time lows, PE multiples that are all-time highs. But I think that is a derivative of central bank manipulation. So my point is, being short the last couple of years, I think we've been dead on in terms of our thesis and the way we're thinking about things. But, when you're short a company and, that company has access to basically free capital and, could issue equity, and in normal times that company wouldn't be able to issue equity. And you talk about the IPO market and all these unicorns, and even though you start seeing that market crack a little bit, that's all been driven by easy money policies. So, I think I talk about, right, the market being expensive. Don't know how much longer this could go on, but I also think that the Fed is going to continue doing whatever they can to keep this going, and ultimately the longer it goes on, the bigger the bust will be. But I mean, is that tomorrow? Is that 3 years from now? So So anyways, with that thinking, our short exposure is less than it's probably ever been. Most of our protection on the portfolio, is done with, deep out of the money put options to where very little capital is at risk. But, if we're right and if it's significant, it'll pay off in a big way. And, once again, just really focus on the long side on building the portfolio from a bottom-up basis. And, like I said, we've underperformed the index funds over the last couple of years, but in theory, even if this continues, we should be able to outperform with some of the names in the portfolio as they work. We're just waiting for them to work.
Does that keep you up at night, or is there something that keeps you up at night?
Oh yeah, well, every single one of the stock holdings in our portfolio that I am responsible for, every single one of them keeps me up at night. So
For sure. So obviously you're not the sole owner of the business. You are in a partnership, but down the road, if y'all had the success at this burst that you think might happen, and somebody approached you with a ludicrous offer, would you consider handing over the business, or you want to keep your hands at the reins for the foreseeable future?
well, so 5 years ago, I would say for sure keep our hands on the rein forever. And that's still my answer. I just like I said, the last 5 years, it's just been an interesting time, right? Because you feel like you're doing a lot of things the right way, but it doesn't matter. And I don't know. One of the kind of the owner managers, capital allocators that we follow, and we own his holding company, and a lot of the spinoffs in the portfolio is, his name's Howard Jonas, and I read an article a while ago, and the question was kind of, what's kept you grounded with all this success you had, and he's had several $billion exits. And anyways, basically what he says, he goes, look, I've learned in life that, he didn't say it exactly this way, but basically what he said is, being good at what you do, being smart at what you do, working hard at what you do, that's like the ticket of admission. That gets you on the playing field. And then from there, he said, don't underestimate the role that luck plays. And, so I think about that, right? And, don't underestimate the role that luck plays. And, and sometimes people that work hard and are right are just unlucky, and maybe, they were right, but it happens 2 years later and they're not in business anymore. So I don't know. I don't know. You'd have to weigh the situation, but the one thing that I can tell you is we love what we do, and there's nothing else we'd rather be doing. So, I don't know that I would want to work for someone else. So, yeah,
Absolutely. On a more, I guess, future-looking note for some of our listeners and anybody out there looking to make something happen with their life, what would be some of your key points of advice for getting a business up and running, kind of from the ground up?
Yeah, well, so I'd say, in the investment, but clearly, you need to get the business side right. But there's all sorts of service providers that you can surround yourself with. But I would say, in terms of learning the business and learning investing, like I said earlier, there's like a treasure trove of resources out there, and one of my past partners, when people would reach out to him and, be looking for a job or an internship, he would, I told you I gave this guy a list of 5 books, and I learned that from one of my previous partners, but he would, give these people that called a list of 5 books to learn, and he'd say, once you've read these 5 books, give me a call. He said, 98% of the people never call you. It's not that easy to read a book, right? And it's not that easy to read a book if you're not passionate about the content in that book. So, I'd say there's a treasure trove of stuff out there, and there's a lot of great owner managers and business leaders and investors and visionaries. I mean, you could, it's almost like you can get your MBA and CFA and doctorate in investing just from, we have reading our bookshelf out there. So.
Definitely. And, when you're feeling stuck at any point in time, is there any particular people or books, like you mentioned in particular, that you like to look for inspiration to, bring that motivation back to you?
So there's a great coffee table book we have in our office. It's called The Great Minds of Value Investing. It's written by William Green. And in the book, William Green, he profiles, I think, 50 who he thinks are the 50 best value investors. And it's great, as you go through those profiles, a lot of the stories are kind of the same. And the two that stuck out to me there was one with one profile on Jean-Marie Avalier, who ran First Eagle, and there was another profile on Donald Yackman. And both of these guys, I mean, it was almost like the same story, but, they were managing money like at 97 or 98. I'm going to say the wrong numbers, but it's something like Donald Yackman was running $1 billion in like 96. And by 1999, he was running less than $100 million. And he was just, depression, felt stupid, didn't know what he was doing. Am I doing the right thing? Anyways, fast forward, 2000 happens. Today, Yackman's managing $30 billion. And so, I like to read kind of those, on certain days where it's like, gosh, man, the market's up 20%. This is crazy. But, so a lot of inspiration out there.
For sure. And at this point in time, what are you most grateful for in your life? Is it the business, personal? What are the good things going for you?
Yeah, I'd say my faith, my family, and our business. Those three things. And I think if you're strong in the first two, the third will, take care of itself. But I think if your priorities are right and on the business side, if you're doing the right thing and keeping your head down and and working hard and constantly checking your blind spots, I think you'll be okay. I think that's so that's I'm excited and happy about everything that's currently going on, and looking forward to the future.
Definitely. And on a more personal note for us here and what we're doing on this side of things, is there anybody we should look to in the future to reach out to, speak with? Anybody you think would be a good candidate for one of these interviews?
Oh gosh, I mean, there's the thing that I probably hold nearest and dearest to me in my business would be just my network that I've built up. And when I say network, I don't mean clients. I mean other people that do what I do. And we'll talk offline. I'll give you a bunch of names. You probably know a lot of them, but there are so many people that are passionate about this business and good at what they do. And I would say that I just hope for these investors that they're just able to attract the investor base that we do, because I think the only thing that sidetracks a lot of people is just not having the patient capital to enable you to enact your investment discipline.
Yeah, actually, not just the investment business. We're also interested in interviewing other businesses, not just limited to the investment business.
Well, who you should interview, and I don't know if you'd be open to being interviewed, but I know you profile a lot of great business leaders and capital allocators, and like I said, that's a big part of our process. And I've said this before, but imagine had you identified John Malone as a great business allocator, as a great capital allocator and business visionary 30 years ago, invested alongside of him. How have you done? Right? You've done really well. imagine how had you identified Warren Buffett 50 years ago and invested alongside of him, you've done great. So, one person that I talk a lot about, and I identified him as a kind of a visionary and great capital allocator several years ago, is a gentleman by the name of Howard Jonas. And Howard Jonas, he's very apparent in our portfolio. I think our Howard Jonas basket, as I call it, is probably a 12% position in our portfolio. But he started a telecom company in 1990 called IDT Corporation.
Yeah, I know that.
And they kind of pioneered the international callback business. So basically, they had a technology that could cut long distance bills, by 80%. And he's done a great job building that business. That business does $1.5 billion in revenue today, but it's a business that is in structural decline. You have free VoIP providers like Skype and like WhatsApp, and as those new technologies that put pressure on the international minutes business, they've done a great job at kind of running that business lean and taking the cash that business generates and buying a basket of growth initiatives. And if you just look at the last 10 years, starting in 2010, so since 2010, he has spun off 5 different businesses from IDT Corporation and sold a 6th. But if you invested in IDT Corporation in 1990, you've made like 50% per year for the last 10 years versus the S&P, which is up 10%. So, we have a stake in IDT Corporation, and although that business is under pressure, they still have 2 growth initiatives within that business. They have a UCaaS initiative called Net2 Phone, and they have a point of sales business called National Retail Solutions. So anyways, I don't know where I left off, but Howard Jonas, and so we own IDT Corporation, which still has 2 growth initiatives within it, but we own each of the spins. So he spun off a company called IDW in 2009. He spun off Zedge in 2017 and Raphael in 2018, and we own all 3 businesses. The business that I didn't mention was Straight Path Communications, which was sold, but it's a good story and kind of demonstrates his vision, and I think most importantly his ability to be patient. But in 2001, when WinStar Communications went bankrupt, I think Howard, he identified the future of spectrum and airwave licenses and what a big business that would become. So when WinStar Communications went bankrupt in 2001, he bought a hodgepodge of spectrum licenses from WinStar out of bankruptcy for $50 million. And he's kind of held that asset all this time. And in 2011, I think he spun off that hodgepodge of spectrum licenses as a company called Straight Path Communications. And he sold that business last year to Verizon for $3.1 billion, and he owned 20% of the company. So that was a pretty nice exit for him. But definitely someone that has an amazing capital allocation track record. He has several billion-dollar exits, and someone that we've followed closely. But anyways, he'd be a great guy to interview if I could. If you're interested, maybe he'd talk.
Absolutely.
Definitely.
Yeah.
So if you can make
great.
an introduction for us, that'd be great.
Yeah, I will.
Alrighty. Well, for our side of things and our purposes, that'll round out our questions that we got at this point in time. So I know I speak for myself and absolutely Charlie as well. We were really appreciative of having you on the show today. We really, really did have a good time talking to you.
Thank you very much.
No. As did I. Thank you very much, guys.
Thank you so much.
See you next year.
Talk to you soon. You got it. Bye.
Absolutely.